Look, welcome everyone. My name's Simon Moore. I'm the managing partner and founder of Blue Wren Advisors, and I'm very pleased to be your host for the Moonshot House 2021 Fintech Forum, hosted in partnership with our good friends at Plug and Play. Moonshot House is a virtual invite-only community for leading investors, corporate executives, and entrepreneurs. Our members utilize our events to connect with other leaders, build on business ideas, learn about emerging trends, and find investment opportunities. Since its inception in 2020, which was only last year, Moonshot has onboarded over 200 leading executives across 26 major cities all over the world, from companies like Google, Amazon, Microsoft, and many others. We run about 20 events each year for our VC and CVC members, bringing together some of the world's brightest minds. Today is day one of a two-day FinTech event hosted in partnership with Plug and Play, which has been uniquely shaped by and for the Moonshot community to address the topics most relevant to our investors, entrepreneurs, and innovators. And we are in for a treat. We're going to be discussing the emergence, the state of the art, and institutional adoption of cryptocurrencies, banking's digital transformation, the emergence and influence of challenger banks, digital payment processing, the impact of decentralized workers and international money transfer, the growth in retail trading, developments in insurtech, corporate innovation, culture change, and many other topics. It's going to be a jam-packed few days. Today, we have a series of speaking sessions, panel discussions, and startup pitches. We're going to start off with a keynote and Q&A from Gene Hoffman, who's the president and COO of the Chia network. We'll then move into a panel discussion with some investors, moderated by Christopher, who's the founder and CEO of BizFamous. We'll have a presentation from Plug and Play by Nadine Moore, who's a director over there, a former colleague, and a series of startup pitches, which you'll want to stick around for. Tomorrow, we'll have 4 workshop sessions led by experts in VC, entrepreneurship, and innovation, which will be very cool. We'll start off with a fireside chat with Kimberly Greer, who's the head of research at Chain Analysis. Then we'll have workshops with George Demooney, who's a partner at Plug and Play, Jeff Tan, the head of innovation at Dentsu. Yours truly will be leading a workshop. And then we'll also have Christian Peverelli, who's the CEO and founder at We Are No Code. In terms of housekeeping for today, encourage you to use the chat function to send in any questions you have through the event. This community is differentiated by the caliber of the community and the depth of engagement. So throughout the 2 days, if you hear something you find impactful, quotable, or otherwise, please share your thinking and put some quote marks and whack it in the chat with a comment, and let's drive some engagement and conversations around that. I encourage you to do so. We hope you enjoy the event and apply for a membership at Moonshot House as a result. This is actually one of the first public events where we do have folk from outside the community, so view it as a taster. So without further ado, let's hop into our keynote address. So Gene Hoffman, CEO and president of the Chia network. And the Chia network is a blockchain and smart transaction platform backed by the who's who of Silicon Valley VCs, including Andreessen, Naval Ravikant, Greylock, and DCM. Mr. Hoffman is a former NASDAQ CEO and serial entrepreneur, having built and scaled companies in enterprise software and SaaS, consumer subscriptions, cryptography, and software development. Over the course of his career, he's raised over 150 million in public and private markets. He's acquired 4 companies. He's sold 3, notably to PGP Incorporated, Vivendi Universal, and Amdocs. He's been a board member at 8 different technology and energy companies. He serves on 2 nonprofit boards and one which he co-founded. From 2003 to 2016, he was the co-founder and CEO of Vindicia, which was a consumer subscription infrastructure company sold to Amdocs in 2016. From 2017 and 2019, he was an advisor to the board of Chia until he joined the company full-time in August of 2019. And this has been a massive month for the Chia team, with version 1.0 of its blockchain launched just this month. So congratulations, Gene. It's awesome to have you here with us. I'm looking forward to hearing about the launch. And we're very privileged to have you with us today. So the floor is yours, and I'll return for our Q&A after your prepared remarks, and over to you.
Excellent, thank you. And yes, we just launched our blockchain last Friday to no real drama whatsoever. It was very beautiful to see it just roll out and work great. People are out there farming. In fact, we've gotten to a place where we have at least 4,000 public nodes and about 11 or 12,000 nodes totally visible. So depending on how you look at it, we're certainly in that kind of top 10 or even top 5 of all blockchains out there by public node count. It's going to be a massively decentral thing. I'll come back to Chia.
Yeah.
And we'll also talk a little bit more on the questions. But my remarks today are that I wanted to kind of back up and talk about what we think is wrong in blockchains and what we think is right and what the opportunities are. And I think one of the first places to go is to say two things that are really important. And there are two categories of things that are problematic. One is how proof of work ended up working from an energy usage perspective. And the other one is programmable internet money. So let's start with the first. Bitcoin is almost perfect. It has these two issues, and we'll talk about those two issues. And it's interesting because Satoshi wrote in the white paper that, you know, there are all these other things like IP addresses or other things that you might be able to use to de-anonymize or choose your validator randomly. But though they won't work because you can completely and totally fake an address. There are all sorts of problems with these, and these are what are called Sybil attacks, if anybody wants to Google it. But he said, you know, one CPU, one vote, and it's literally all hyphenated right there in the white paper, might work. And I think he was onto something. That thing he was onto was he was looking for a globally available, underutilized commodity. And unused CPU cycles was that. But of course, we've all seen since then that it turns out that generalized computers aren't very good at doing a specific task in a compute. And the SHA-256 task at heart of proof of work has shown that basically what's happened is that proof of work has immediately moved quickly to specialized hardware and is, you know, converging on the cheapest sources of electricity. This has significant downsides, and it's not just the electricity side. Now, I do think that a lot of the hype about, oh my gosh, Bitcoin is going to destroy the world by electrical use is overhyped. That said, to get blockchains and financial blockchain infrastructure to the scale that I think we all want it to be at, you project forward a lot of electricity usage that doesn't necessarily seem to be required. But coming back to this massively available, decentralized commodity, we think storage might be that, and we'll come back to that in a second. Others have kind of addressed this and said, hey, look, what about proof of stake? Proof of stake blockchains, again, suffer a couple key issues from our perspective. One is that stake is kind of naturally centralizing. The people with the most of the currency are generally going to earn more of the currency. And that's before you kind of analyze how exchanges interact with proof of stake chains. Recently, we saw a Steemit chain have an exchange kind of vote this chain a different direction than I think what most of the actual stakeholders wanted. Ended up being a chain split, and a whole new set of chains came out of it. But the point being, you kind of get into this situation where you're centralizing your blockchain, and that is exactly the opposite of what everyone's looking for. And it's probably worth stepping back a little bit about why centralization is so important. You know, if you have an international monetary transfer regime, you're going to want Pakistan and India to both be able to use it. You don't want to have a situation where we're kind of already at where almost all major transfers end up going through New York. That's not the kind of future financial infrastructure I think everybody has in mind when they kind of fast forward what blockchain's ultimate impact will be. So when proof of stake chains, when you start centralizing all the control folks, well, all of a sudden you're kind of getting back to exactly the hegemonic G7 dominance of certain countries in how money and fintech flows. There are other problems with proof of stake. One is that long-range attacks are really problematic. And what a long-range attack is that you go and you buy a bunch of the coin and you stake it and you let it run for a little while, and then you sell it and you, for example, pay back the loan you got to buy it in the first place. But then you go create a private version of the chain and you extend it really far, and then you become the better chain. And you merge that back in, and all of a sudden you never sold the $1 billion you borrowed and put into the chain. There are a lot of technological attempts to solve this problem, but all of them continue to add complexity and make it harder for people. People talk about slashing. The problem is then that it creates incentives for bad guys to get good guys slashed. It's just a tremendously more complex kind of solution. And I think the last two significant flaws for proof of stake are that 51% attacks are 51% of the value of the stake chain. Today, most people are thinking about blockchains as against enterprises, but we think that blockchains are going to get to the scale where it's going to be as between nations. And as between nations, a nation can pretty easily buy most current proof of stake chains out of current budget. And once it's worth it, I think they will. And the problem is that once you 51% attack a proof of stake chain, you own it for an indefinite future. With proof of work and Nakamoto consensus, that's not true. So even a 51% attack, if more honest space or mining capacity comes on, you recover. And we think that's an important feature of that. So we think that the energy use question is real. I think it's a little bit overhyped, but when you start pushing these numbers forward, we think you want to spend thousands of times less electricity per unit of security than you're currently spending. And that takes me to the other major issue. Bitcoin is now 11 years and older. And when Bitcoin was originally launched, I don't know that everyone understood or thought about what sorts of programmability you'd really want to be able to make cryptocurrency easier to use than cash. And fundamentally, it should be. It actually should be the easiest instrument that you use no matter what. But Bitcoin script was very, very limited and is only now starting to kind of come into the future. But that's slow, and it's going to be difficult because there are a lot of kind of core architectural decisions that make it hard to do Turing-complete style scripting. And of course, this is where Ethereum has kind of stepped in and created Solidity and has started, I think, the initial spark. And, I love the Ethereum guys' spirit. It's let's go, let's do something, let's innovate. But I worry, as someone who has run enterprises and actually had significant dollars on the day-to-day, that they have not run an enterprise-sized database at scale on the internet or stored the equivalent of a couple 100 million credit cards. Those things show in a lot of the architectural decisions. And in fact, I think where the really positive news in all of this is that the projects that didn't launch in 2017 are actually probably larger than the entirety of the addressable market that we currently see in the entire blockchain space. I think a lot of banks and governments and hedge funds and mutual funds and others seriously looked at wanting to be able to adopt a blockchain to run their day-to-day infrastructure, or to issue assets, or to issue equities, or to issue central bank digital currencies. And what they found was a JavaScript implementation and a bunch of architectural decisions that CIOs of banks weren't willing to bet their careers on. That has hampered a lot of the adoption that I think we all hope to see. What we saw as a reaction to that is a lot of people running what I would call private blockchains, which of course kind of nullify the point of a blockchain. The point of a blockchain is to have Metcalfe's law there and to give you more network value by actually having the network effect. That is in some ways a glorified Oracle database, and especially when you have trading partners you kind of trust, you're not really using the blockchain for the things it's good for. And that doesn't even get into things like uptime, where a globally distributed, fully decentralized blockchain has this great property that it's almost always up 365, 24/7. It's actually very hard to slow down or stop. But when you're running those kind of intranet versions of blockchains, that's not necessarily the case. So there are tremendous demand, and I think strategic demand, for certain countries to issue their currencies on a blockchain. I think a lot of sovereigns in what I would call the G20 to G50 countries have real strategic needs to be able to transfer money, to transfer wealth, to do the kinds of things we all want blockchains to do between one bank in Asia and another bank in Asia. I think that is actually an unmet demand out in the market, and I think there's real need for it. I also think that this is going to be a classic disintermediation. We've seen this before, Bram and I. Bram, obviously the founder of Chia. He also wrote this little thing called BitTorrent. He and I both kind of pincered the entire music industry. I from the licensing MP3s and selling actual commercial music online. Him from proving that both piracy was always going to be there and no one should make money from piracy in the first place. It's interesting, though, if you really look at the music business, and the reason I bring it up as an allegory, a lot of middlemen did get squeezed. But interestingly, most of them just innovated and changed. So one of the classic middlemen in the music business is an entity called the Harry Fox Association. And it Used to be a guy named Harry Fox that you would call to license music. Well, now it's actually a big data infrastructure company helping do royalties for YouTube and Google and Spotify. And I think a lot of what's going to happen in the financial infrastructure is similar. I do think that that blockchains are out to undermine SWIFT and foreign exchange and Fedwire. But in fact, what will happen is those entities and organizations will instead adopt blockchains to do the things they want to do much more efficiently. And I think, GameStop is a great story here. DTCC in 2 days settlement drove a really unhappy outcome for a lot of investors. And, this is exactly the kind of the wrong thing that banks and investment banks really want to be sending messages to Main Street about. Being able to start getting closer to a regime where settlement is a minute or minutes, where that's actually no risk or low risk, I think that's where we have to go. And I think what's going to happen is that as more trusted tools, more scalable tools, and more decentralized tools become available in the blockchain space, that these entities like DTCC or SWIFT or others are going to adopt them and start to have the kinds of future and better use cases and user experiences that we're all looking for. So, with that, just a little bit about Chia. Obviously we have come up with a new Nakamoto consensus, the first new Nakamoto consensus since Bitcoin. It is called proof of space and proof of time. It works by people allocating their unused hard drive space to be validators on the network. We love that because there was a zettabyte of storage shipped last year. There was about a $60 billion revenue market for just PC storage and server storage. There's another, call it $50 billion worth of flash that goes into phones and IoT devices. And there's a lot of trapped unused storage. People have to have that storage on and using it, and it would otherwise make the money potentially to validate Chia. And the neat thing is there's no such thing as a storage ASIC. It's actually a thing called NAND SSD. And that brings me another kind of fun point about proof of space. Soon, consumer SSD prices per terabyte are expected to be less than hard drives. And once that happens, it's very, very efficient to farm Chia to validate transactions. A word about proof of time. There are problems that both proof of space and proof of stake have that proof of time solves nicely, especially for space. What this is there are servers out there grinding away in a way that can create the passage of time and guarantee that time has passed. And it doesn't take a lot of them. That's what's great about this. And so it keeps it all very green. On the second problem, we have launched a project we call Chia Lisp. Chia Lisp is a Lisp language derivative. The way I like to explain it to folks is that as Rust is to JavaScript, Chia Lisp is to Solidity. It is not as easy to write. But the neat thing about Chia Lisp is that once you write a Chia Lisp contract, you know for sure what it does, and it's actually auditable. It's the kind of thing an SSA 18 audit can be based on. And so all of a sudden, that CIO of a bank or a major comptroller can rest easy that, in fact, the smart transactions they've written actually do what they expect them to do. It's also written in what's called the UTXO model. This is the coin model. For those of you not very familiar with this, Bitcoin uses this. Basically, every transaction only kind of creates a coin or destroys a coin. And what Bram has come up with is a Turing-complete language that fits in that. And that sidesteps a lot of the problems that I think you see in Ethereum that are about their account style, management of Solidity, and the kind of global state change that updating anything is. So we think it's a lot more scalable in the general sense. So, with that, we have a transaction lock on that will come off around April 29th. And so first transactions will happen April 29th, May 1st. And so, Simon, that kind of concludes my stated remarks, and would love to take your questions and then everybody else's questions.
Yeah, fantastic. Well, and so folks who are on the line, feel free to use the Q&A box as we move into our Q&A session. I've obviously got a few preloaded softball questions for you, Gene, but we'll get a few coming in from the community in a second. If we scope out, I mean, you mentioned, and this is on the institutional adoption. Could you give us a sense of like roadmap? Like what do you see in terms of timeline over the next, say, six months to a year in terms of institutional adoption? And then maybe if you give us a prediction about 2 years out, like what's the world look like over that time frame?
Yeah, so I think the use case of Bitcoin as store of value is very, very real. I mean, the thing that always drives me a bit nuts when people are like, Bitcoin's backed by nothing. I'm like, exactly like the US dollar. The US dollar has only one other feature: you can pay taxes with it. Um, and gold's always been funny to me that it's a store of value. Gold costs you money to protect.
Mhm.
Bitcoin doesn't really cost you money to protect. It doesn't cost you money to store. So, I think for the foreseeable future, you're going to see continued adoption of Bitcoin as an inflationary hedge. And I think that's a snowball that's going down the mountain faster and faster. I don't see that changing even for the next couple of years. I think what's really up in the air and what has a lot of volatility and change coming is the programmable money side. You can't really make Bitcoin issue an asset class that is, say, an equity or a ADR or a municipal bond, right? And right now, you see early experimentation with DeFi and digital exchange on Ethereum, but you're not yet in a place where institutions with real money at risk feel comfortable using that infrastructure. I think
Mm.
that's an 18-month change, though. Obviously, at Chia, we believe that it's going to take some time for Chia Lisp to mature and build that kind of development environment. But it comes at the problem thinking about how does $1 trillion move through this in a way that's auditable, not, YOLO, let's put it up and hope the unicorn works.
Is the continued interest in terms of the, we've seen uh, Bitcoin rise again recently in the last 6 months or so in terms of value. Does that hinder its adoption in insofar as it's has a subjective sense of volatility, but as more people adopt it, the price goes up?
Well, look, there's one thing that you've got to have some volatility, right? You can't kind of get to being an asset class the size of gold without going from here to a lot larger number per
Hmm.
Bitcoin, right? Um, Though I also think that as you see more institutional adoption, you actually see volatility start to lower. One of the things we don't have are some of the equity side, ETF and other sorts of tools that would, in many ways, potentially lower this volatility. I mean, it's still very early. It's even sort of hard to, as a market maker, easily arbitrate across just the digital money exchanges, much less that and the public equity market. So I think that as we start to see more ETFs get on more mainstream markets, so not the OTC, not the Canadian markets, but Nasdaq or NICE, and I think that's ultimately going to happen. And I think there's an important thing that everybody needs to know here, like the 40 Act side of the SEC, and this is the group that manages hedge funds and mutual funds and ETFs, are still very skeptical about Bitcoin. They kind of don't believe that the market depth is there, that it's real. I think anybody who looks closely figures out very quickly that there are absolutely exchanges that aren't real, but that the majority of exchanges that we expect are absolutely real, that the volumes are real, that all of the human foibles in trading are all there, right? So you actually have a deep market that's very legitimate. That's different than the 33 and 34 Act side of the SEC. That side is the capital formation, public company side. And I think they're already very well bought in, though I think they remain skeptical of ICOs and all of the unregistered securities offerings that happened, right? But back to the volatility question, I think as we start to see more of these tools, and it already has helped that we've seen futures and other pieces on Bitcoin, that the leverage and tools that we all know in the financial sector will start to move that volatility out. Well, you'll still see significant price appreciation. I mean, I think there's no way out of that as people
Hmm.
continue to make that mental switch to this is better than gold.
Yeah, yeah. We've got some related questions around institutional adoption, around DeFi, and you mentioned all these sort of intranet-based blockchains. Like, how do you see in terms of the speed of adoption? Like, is there major value to be realized that's just sitting there waiting on the table, or are we at a stage where it's too technical or too immature, and so you just have one or two leaders who are leading the charge? But that's what we should expect over the next little while.
Yeah, look again on the institutional class investment side. I don't think we're late. I think we're middle of
Hmm.
adoption. We're starting to cross that chasm, but I don't think we've even begun to cross the chasm on the programmable money, the asset issuance side, the DeFi side. Certainly there are real balances being experimented with, but there are real limitations to Solidity and Gas and Ethereum that I think are going to hamper anyone bringing serious money. And I one of the things I worry about a little bit is that when you get this intersection of crypto developers and the financial markets, crypto developers have a hard time understanding that you could borrow $1 trillion overnight, but that's actually like from a finance geek perspective. Yes, of course, if it works, right? And so there are a lot of these things where the scale that people are talking about really don't kind of encompass the scale that's necessary to start getting to liquidity pools and credit risk that all of us really kind of want to get to. And I think a lot of that has to do with there are a lot of poor architecture decisions in the current stuff that people are messing with. There's also a lot of more serious developers who kind of got unhappy with both Bitcoin and Ethereum. On Bitcoin, it's the whole miner versus developer, and like the developers are treated like crap, honestly, by miners. I've never really understood that because fundamentally you want your technology to be good that you're investing in. But anyway, and on the Ethereum side, for people who have written real financial software, you kind of look at this and you go, man, this is scary. It's hard to reason about its state. I don't know where it goes. And we see the result of this. It's like 8 million from this sushi swap was stolen this morning, 11 million from that one the next day, 45 million from that one. So, those headlines need to stop before you see, the Fidelities of the world enter DeFi.
Mm. Yeah, very interesting. You mentioned that how blockchains, as a source of disruption, international money transfer, these various middlemen. Could you talk about who the biggest losers are from the rise of these instruments, and what you expect to see from folks like I think you mentioned Swift as one potential source of or target of disruption?
Yeah, so I think the easy loser to point to is the gold market. Like, I fundamentally believe gold and silver markets are going to have their own unique issues because I think a lot of commodities are now going to go back to their commodity value. And like the jewelry purchase of gold is like half the size of the market, right? And so, you go, ouch, that'll hurt as an adjustment, right? But, look, we already see the competitive pressure from disintermediation. Swift has gotten a lot faster all of a sudden, and they've talked about all sorts of modernization programs. What I expect you'll see is folks like DTCC will get more comfortable with settlement on chain. And, when there's chains that can settle in the, 60 second with real certainty in 10, 20 minutes, you start lowering your capital risk at risk. And I think the good old fashioned capitalist reasons will drive these folks to adopt these kinds of technologies. Again, it's everybody'd like the security guarantees of Bitcoin, but they need the programmability of Ethereum, and you can't marry the two well right now. If you look at the projects, it's like Bitcoin. Okay, I love the distributed nature, even though it's a little too centralized. I mean, a certain nation can roll troops and grab 3 people and have a 51% attack on Bitcoin, right? That's not where you want to be if you're a national bank. You look at Ethereum and you go, okay, getting there. But man, architectural decisions that are not the ones I would want to make as an enterprise, not the sorts of things I can reason about or get an auditor, a financial auditor in to prove. And now you're at like Ripple and Stellar. And these are not projects that, you really look at and go, okay, great, I can go do this. After that, it starts being things like Cardano. And, there it's like, okay, but do I believe proof of stake is safe? And, I think there's a lot of reasons to be skeptical that proof of stake is safe. And so, you just don't have a lot of choices if you're trying to significantly do something like an actual billion-dollar pilot for DTCC. But I think that's coming. I think that's coming in the next 18 months.
And that's into Chia. So shifting gears a little bit, let's maybe scope out just a bit in terms of fintech generally. And we've seen traditional banks in arms race with challenger banks, particularly here in the US. I'm right now sitting in Sydney, Australia, and have been living in the US for a long time and haven't interacted with the banking system down here. And I'm shocked at how easy it is to transact with other banks. With is it personal transactions or commercial transactions? But maybe you could talk about what you're seeing in terms of key trends around challenger banks, what you see coming down the pike.
Yeah, well, I used to have a lot of people come to me and say, "Hey, look, I'd love to disintermediate Visa and MasterCard," and I had to do the kind of difficult explanation of it's just good enough that you really can't easily unseat it, right? And I think that's what's been going on a little bit in the United States and other places where banks have been able to be a bit complacent. Almost all of fintech has been built one layer above them, right? We were all getting merchant accounts, right, or we were getting an issuing bank license from. So it was all that next layer up, and all of a sudden, blockchains as they scale up have the real ability to start saying to Stripe, "Hey, you could natively transact. You can natively transact, Mr. PayPal," right? And I think all those people see that. It then comes again back to the infrastructure's not quite there yet, but I think that's going to start creating the competitive pressures that drive both, younger, smaller banks, and we're starting to see this too with just like people willing to bank Bitcoin exchanges, right? I mean, that was the first big thing. But that competitive pressure drives people to go, okay, I guess I've got to get Zelle working everywhere. It's got to be pretty cheap. Right now it's not super cheap to transfer money on certain chains, so maybe I'm not at that pressure yet. But anybody who sends an international wire immediately goes, "Oh, this is horrible." It's no joke to say that it's almost safer to put money in a suitcase and fly with it. Faster, you know where it is, right?
Yeah, yeah, absolutely. Um, yeah, it is fascinating. I seem to remember a Planet Money episode talking about decisions made in the 1970s around the centralization of check clearinghouses, which still is our system today.
Well, look, we were flying checks around every night as late as the late 90s. That even kind of lingered into the early 2000s. I think folks have no idea how like antiquated the underlying infrastructure actually is. OS2 still runs, I think, on many ATMs across the United States, or if not, it has been removed very recently.
Yeah, amazing. Let's hop into equities. I mean, obviously, big headlines around GameStop and all this sort of stuff. But can you talk a little bit about power shifts in the equities market? What you're seeing in terms of Wall Street versus Robinhood, retail traders, that kind of thing.
Yeah, look, I think there's certainly that it was a wonderful wake up call to have professional shorts realize that they too could be shorted with. And I think that's important. I mean, we're talking fundamentally about democratization of fintech across the board. And look, if there's one like overarching arrow of technology over the last 25 years, it is that end users will end up with more control. A lot of people complain about social media. It's kind of like, no, what's happening is people can actually be heard now. And well, that used to be limited to the coffee table and it's not anymore. But look, this is the trend, and so the trend is that the retail investor may actually be able to set the expectations for an equity better than the equities markets can. And I mean, and to me, the story there was actually Tesla and not GameStop. You had this like ongoing bluff call by a large number of short sellers who were like, "There's no way people will buy electric cars," while they were buying electric cars.
Right.
And what was really funny to me is that the retail investors got it, and in fact did very, very well by being contrarian. There's a famous prediction by Elon. He said, I think around 2012, somebody asked him, when will you get to scale? And he's like, well, I think we'll be selling about 500,000 cars a year in 2020. He was off by 5,000 cars, which, in the 5-year forecast category is, perfect, right? But he took no end of grief in 2012, 2013 over that prediction. And I think it was the people who bought the car, and, it's that classic investment thing of like, if you like the product, you probably like the stock. That was one of those situations that happened. And GameStop's a little of that example too. I mean, I think lost in the GameStop conversation is that GameStop is a surprisingly good company. Like underneath it, its fundamentals do not match what you would expect from, like, gosh, Blockbuster Video. You'd expect it to be in that kind of financial shape, not the kind of financial shape it's in. But look, what we're heading to is there's no good reason in the internet age that you can't clear transactions same day.
Mm-hmm.
Right. And I think that unlocks a ton of capital. I mean, like think about all the capital that's locked up right now for equities trading that shouldn't be there. It should be much more fluid, much more close to what the actual, hourly risk is. I don't think it's a minutely risk, but I do think it's something like that.
Well, Jane, I think we've got time for just one more before we hop into our next session. But look, scoping even further back, I mean, are there any particular fintech trends? We've got investors, we've got corporate innovators on the line, we've got entrepreneurs. What do you see is going to be? What are we going to be talking about next over the next 6 to 12 months?
I think that the accredited investor standard is going to have to continue to be relaxed. I think it's a bit condescending to take the 1930s attitude that you're too dumb to buy private equity. I also think that, it's a little bit of the Sarbox switchback to, get rid of the excesses of the dot-com era, right? Meant that like being a public company became kind of out of reach of most people. You couldn't invest in a future public company. You had to wait until it was public. That's changed. Growth happens now at what used to be the mezzanine area of capital raise, and I think more people need to be able to get exposure to that. And I think it's a difficult thing in a populist kind of world to say to folks smart enough to like move GameStop that they can't buy Uber 10 years ago, right?
For sure, for sure. So look, as we close, is there, if folks want to learn more about what's going on at Chia, or is there anything you'd like our folks to know as we depart?
Yeah, I would say check out Chia.net. Unlike most internet crypto projects, our white papers are both either academic papers and extremely dense, or they look a lot like an S1's business section. So.
Fantastic, and I'm sure folks can find their way to the link. So, Gene, this has been really very robust and in depth and very insightful. So, thanks so much for spending the time with us. Really, really appreciate it.
Thank you, Simon.